In today's episode, I've got a 69-year-old client looking to solve their long-term care needs, and I'm going to take an alternative approach to traditional long-term care because that usually includes premium hikes, so the policy gets so expensive you can't afford it 10 or 15 years down the road. And secondly, if you die before you exercise that contract, then you usually forfeit your premiums to the insurance company. This alternative would give you the flexibility of having a death benefit attached, so your beneficiaries would end up with the remainder if it's there. And then secondly, they do not include premium hikes. So let's jump into the illustration so we can learn a little bit more about how this solution works. I have the illustration open and I've also attached it. Please be sure to open it and review all of the disclosures before you proceed to watch this video. This video was created for education purposes only and not to be taken as tax or financial advice. So with that said, let's continue. This is a fixed annuity with a long-term care benefit rider attached. It's for a 69-year-old and the premium is $100,000, and I'll explain later why I chose $100,000. I'm going to zoom in so you guys can see. This second page is a disclosure page, and please reference the attachment for that. On page 3 in the top left, we have the interest rate guarantee. In the first year, they're providing a 3.75% guarantee interest rate. In years 2 through 9, it's 1%. And then in years 10 plus, it's 0.10%, 10 basis points. Now, years 2 through 9, this 1% could be higher. It could be 3.75, could be higher. It's just guaranteed not to be lower than 1%. Moving on to the right, the withdrawal charge schedule, you'll see that it's common with all annuities. If you decide that this product is not right for you, in any year that you decide to leave according to the schedule, you will have to pay that surrender percentage. So in year 1, if you left, it would be 8% and so on and so forth. Now, normally we wouldn't recommend a product to a client like this that would anticipate needing these funds anytime within the next 10 years. So if you're buying it with that in mind, well, you wouldn't buy it. On the left, we're looking now at the coverage summary. So we have a 3x multiplier with this product, which means if you answer the medical questionnaire, usually if you answer all of those questions no, and I'll show you and bring up the medical questionnaire in just a moment, then you would qualify for a 3x multiplier, meaning that they will create a long-term care medical benefit bucket equal to 3x, 3 times your initial contribution. In this case, it's $100,000. So if they qualified for the 3X, they would have a medical bucket, a long-term medical bucket for medical expenses, long-term care medical expenses only, equal to $300,000. 80% of applicants who complete that questionnaire qualify for that 3X multiplier. 14% qualify for a 2X multiplier, so $200,000 medical bucket, and then 6% are denied. Now, that's usually taken over a 72-month period. So if you take the $300,000 divided by 72 months, you'll get an idea of what your monthly benefit will be, and we're going to look at that next. So next I'm going to scroll down to the hypothetical illustration for the guarantee rates. In the first year, we know they're going to provide us 3.75%. We earn that on 100K, 3712. There is a rider charge, and so if we look over here and up 0.00156 per $1 of contract value, and as a monthly charge, hence the $18.88. Now the difference between what we earn and what we pay as a fee for the rider is positive. So our $100,000 contribution has grown to $101,824. Now the next column has a lower account balance. Why? Because like I said, in the first 10 years, there is a surrender penalty, a fee to leave the account early. However, in the 10th year, we see $101,824. Okay, so 10th year, after the 9th year, we no longer have a surrender charge, and therefore our account value is equal to our withdrawal value. Now looking at the next row, 1% is the guarantee now. The 3.75 isn't guaranteed throughout all years of the contract. However, it can never go lower than 1%. We can see that for the next 9 years. So it's years 2 through 9, 1% guarantee. And then all subsequent years or 10 plus years, it's 0.10, 10 basis points. However, that creates a little conflict here, which is the interest earned at 1% is only $1,012. But our rider charge is still $1,906. It hasn't changed. It's a little higher, actually. So that negative would normally be taken from the balance of our account, our contract value. But we see that in this case, it's not. And that's kind of a cool feature of this account, that Global Atlantic will provide you a guarantee that your initial contribution plus the interest you earn in the first year minus the rider charge in the first year, that balance is guaranteed to you even if you're upside down, even if you're underwater on the return on your interest rate, on your interest credited less their rider charge. Now, this has nothing to do with withdrawals. When you start taking withdrawals, this account will begin to deplete. But if you are underwater on what their guaranteed rate is, and we can even see that down here, it's 0.10, $102 was the interest earned that year, and the rider fee was still $1,906, our balance remained at $101,824. And I'm going to come back to that in just a moment to help you guys understand a distinction in these accounts. So let's move to the long-term care coverage. We want to focus on this third column, assuming you fall into that 80% that qualified for the 3x multiplier. They now produced a long-term care bucket for you. This bucket is special in the sense that it can only be used for long-term care medical needs, and it is on a reimbursement schedule, meaning that you will have to cover the cost out of pocket, and then after you've done so, you will submit those receipts to the carrier, and they will reimburse you. The maximum monthly benefit per insured here is $4,167. So they will pay that to you based on the receipts that you submit. If the receipts are less than the $4,167, then that is what they'll pay you. If they're more, you would have to come out of pocket for anything in addition to the $4,167, as that is the maximum amount. Once you qualify for long-term care and begin receiving your monthly benefit, your total long-term care bucket will be reduced by that amount. And there is one important distinction to make here, and that is the insurance company will start with your premium first. Your $100,000 plus any interest and rider charges, whatever that is, this contract value column and death benefit here will be used first. After you use your contract value and death benefit, you will begin using the benefit from that long-term care rider. In this case, it's the other $200,000. The reason this is important is because if you die after using your contract value, there will not be a death benefit for your heirs. You cannot have a spouse on this contract, so that remaining $200,000 in the long-term care benefit rider cannot be inherited by your spouse. It doesn't make the product bad, but it's an important consideration when evaluating this as a solution. So next we're going to look at the non-guaranteed illustration. We got 3.75% in all years. And that produces a positive difference between our interest credit and rider charges throughout all of those years. So our contract value is growing. Now moving on over to the long-term care coverage, we have a long-term care benefit that's growing as well. However, our maximum monthly benefit remains the same. Why? Because the only way for you to get a higher monthly benefit is to contribute more to this account or to buy an inflation rider. That's just the way it works. The benefit here, though, is that with a higher long-term care benefit bucket, that $4,200 a month will last longer. So for those of you wondering about the inflation rider, let's take a look at that. There's a few pros and cons. First of all, we have, as far as the benefits go, if we're looking down at the non-guarantee, we can see that we do have a growing benefit. That's great. And our catchback on the non-guarantee, 3.75% per year, is about the 6th or 7th year, right? Because it's $4,200. We'll call it the 7th year at $4,243. So if we bought this long-term care rider, by the 7th year, we would be receiving a monthly benefit equal to what we would start with in the other product. However, if we have a long-term care earlier, we receive a much smaller amount. It takes 7 years for us to break even there. Another important consideration is this. There is a front load with this account, meaning that they will charge you a pretty hefty fee for that rider, and it's about 24%. Look at that. Rider charge first year, $25,336. So call it 25% coming off your initial investment. Now, if anything were to happen, well, let's say, first of all, you wanted to leave the product even after the 10th year. that amount is much lower than where you started. Let's say you die within those first 10 years or few years. Well, they're not going to receive your beneficiaries the 101 like they do in the other illustration. They receive that premium you made less that 25 or so percent fee for that inflation rider. So when comparing the two, in my opinion, you'd be better off going without the inflation rider and adding more premium, contributing more to start with in order to offset the rising cost of rising medical cost. And so if you're anticipating that 10, 15 years from now, your long-term care cost would be $2,000 or $3,000 more, well, contribute more to the contract so that all the way up until that point, whether it happens tomorrow or at year 15, you'll have enough in those future dollars to cover the cost of those long-term care needs. Now, heading back to the original illustration, the one without the inflation rider, I want to talk to you about the pros and cons, and I have a little notepad here I'll bring up. So first of all, some other considerations is that this account does not permit two owners. And so like I said, you'll burn through that first $100,000 your contribution first, plus interest, less the rider charges. So that could be more potentially, but you'll burn through that bucket first, and then you'll get into the long-term care bucket. In this account, for this example, that represents about $200,000. When you're in that $200,000 bucket, if you die, that $200,000 is not transferable to your spouse or your heirs. You cannot have a second owner to assume that monthly benefit. Next is that it will only accept non-qualified funds, meaning it has to be money you pay tax on, like your savings. It will not take IRA or 401k money, although we do have accounts that work almost exactly like this that will. The 5% compounding inflation rider is available. We just spoke about that, but there is some downside. And the biggest downside being that 25 or so percent fee in that first year. There's a 90-day elimination period. I wouldn't say that's a con here because that's typical with most of these accounts. So you're going to see that with almost every, any long-term care account. It is on a reimbursement schedule instead of indemnity. It's about 50-50. Most of the annuities I'm seeing will be reimbursement, whereas life insurance with a long-term care rider tends to be indemnity. For this account, it is reimbursement, so you will have to cover that month of cost and then submit those receipts to the carrier for reimbursement. There is a small discount. This is a pro here. Small discount if you buy two policies, so one for each spouse. And back office has told me that's about 5%. You are protecting your cost basis with this product, which I do love. So that means, again, we saw if the interest we're earning is less than the rider charge, as long as we haven't taken any withdrawals, well, then they will honor us our initial contribution plus interest minus the rider charge in that first year, which is pretty awesome. You can only grow benefits the benefit base with an inflation rider. So if you want this maximum monthly benefit to increase, I should say, can only grow benefit base. You can only grow your monthly benefit with an inflation rider. And we saw that earlier. You can't do it with the fixed interest returns, not with fixed interest returns, right? That positive. The positive number between the interest we earn and the rider charge. You can't do it there. We saw that. You can do it with an inflation rider, but we talked about the cons of an inflation rider. And then lastly, market returns or the fixed interest. Fixed interest will increase the number of years the client can take benefits. And so that is a pro. If the difference between the interest and the rider is positive, it's added to your contract value and your long-term care benefit base. And that means that benefit base would last longer. So even though your monthly benefit doesn't increase, you will still have and be able to take from that bucket for more months than you would have if you didn't have any growth. So that is what that positive interest added to your account would help with. Here is the medical questionnaire, and I'm not going to walk through all of it. It's pretty straightforward. I'll kind of pause here for a second so that you guys can eye some of these initial questions, but it's not terrible. And like I said, 80% of the people that apply are approved for a 3x multiplier, 14% for the 2x multiplier. Again, just kind of moving through this so you guys can see what the application and medical questions look like. I mean, that is really it. I'm going to attach it, like I said, so that you guys can review it, but it is very straightforward. So I'm going to move into the next section. All in all, it's a great solution for long-term care. We see that $1 to $3 relationship happening with that 3x multiplier for 80% of applicants. We also, compared to traditional long-term care, have a fixed rate, so we don't have to worry about our premiums skyrocketing to a point we can no longer afford them and have to surrender or lapse the policy. In addition to that, we have the likeness of a death benefit for the contract value we don't use. So we know that we have to use our premium or contribution first. However, if we don't use it all, that's left to our beneficiaries, which is another great component of this product. Lastly, the medical assessment. Well, first of all, it's done through a questionnaire. So you don't have to worry about somebody coming out and taking vitals and having to reach out for medical records. This is all done with a questionnaire, provided you're under 70 years old. For anybody age 70 or later or older, you would have to go through the medical questionnaire and a phone interview. Even so, that's much less invasive than a medical exam plus reaching out for all your records. So if you're considering long-term care, you're more than welcome to reach out to us for an illustration. It could be qualified money from an IRA 401k. We have another product for that. Could be non-qualified like what you see today. Different premiums, doesn't matter. And yeah, so just reach out to us here via the social network, or you can email us as well, call us. And thanks so much for tuning in, and we look forward to seeing you in the next episode.